Hello, everyone. Welcome back to the Trading Room. I'm Shane Vernier, and this is the U.S. Mid-Session Brief. Today, we're going to talk about business picking up for midweek trade. We're going to take a look at that volatility index, Bitcoin. We had a trade ID out for Bitcoin a little bit earlier today. USOIL, there's new news coming out of the Strait of Hormuz, a fresh blockade and an extension of the ceasefire from the Trump administration. We had a Great Britain pound USD hit a key level while I was away on vacation. EURUSD did the same, and natural gas did the same as well. So it's always one of those deals once you go to the beach and you put your feet up for a while and maybe eat some shrimp, maybe have a few beers, then that's when you see pretty much everything kick off. And that's exactly what we've seen here in the last several weeks. So I want to welcome everybody back. It's good to be back. I always like doing these live streams and try to help out the traders as much as I can. I've heard from many of you over the past several hours. I just got back in the office last night, and I've heard from many of you, and that you say you're really struggling during this wartime trading. Not really sure what to do and how to handle your risk and things. And all I can say is this: it's a very challenging environment. What you've got to do is you've got to stay diligent. You've got to stick with it. You've got to cut your leverage down, manage your risk aggressively, and make sure that you're not in a situation to lose a significant amount of money during these periods, because it's absolutely unforeseen. We don't know what's happening. Believe me, I probably know a few more traders than you guys do out there, and I've talked to analysts from all over the world, folks that I work with, talking to people on the airplanes, and I'm saying, what is going on here? Spoke with a very successful businessman here out of Dillon, Montana the other day, and we were sort of breaking down what was going on in Iran and what possibly could happen and what were some of the tells that we were seeing in the markets. And right now, uncertainty is the thing. I mean, we are very much in the fog of war. It doesn't matter really what news source you're following. I told the gentleman yesterday, I said, you could pick 4 news sources and I'll give you 4 different stories on what's happening. The people on the ground are saying one thing, the military is saying another, the administration, the Iranians, every single podcaster out there and everybody that's doing live streams is saying something different. And that makes for extreme confusion when it comes to the markets, because right now, believe it or not, we're seeing prima facie evidence that the markets are getting used to the situation. And I knew it would take a little bit of time for this to happen, but it is happening, and I'm going to prove it to you here in just a second. So good to see everybody out there in YouTube land here in the How to Trade trading room. Always a pleasure, guys. Bobby Bob, good to see you. Hi, Coach. NQ is on its all-time high. How do we trade within this Iran war? I hear you. We're going to talk a little bit about the NQ, the NASDAQ here in just a second. Tuku, hi, Coach. Welcome back. Good to have you back. I'm sure glad to be back, Tuku. Thank you for joining me today. This is one of those when we're rejoining during the midweek. I sort of expect a lot of folks probably to miss this one and catch it on replay. But this is going to be a lot of fun. We've got some key things to look at here, and we will dive into that NQ, Bobby, because when we start to see things pushing all-time highs and equities rebound and rally and drive higher, then we're in a situation where life is getting back to normal. And believe it or not, one of the things that the markets are, they're very efficient. They're very efficient. Now, I can debate everybody about asymmetric information and what to make of XYZ or the news cycle or who's doing what, who's bidding what. What I'm saying is this. These markets are resilient, and they're getting used to the idea of the Strait of Hormuz being open a little bit and then being closed. They're getting used to this idea of the Middle East war. And this is prima facie evidence, guys, right here. Look at this volatility index. This is the VIX, the CBOE volatility index. This prices deferred month options premiums on the S&P 500. And as you can see, that long-term average was right around 21. That, for me, is the key level. We're beneath 21. So we had the spike. There's your war month right there. We had the big spike up to about 35.30, and we've come right back down to about 19.45. That suggests that bullish price action, as was just pointed out by Bobby here in the NASDAQ. I mean, this is really what it's all about. People do believe that that the risk quotient, that the unknown unknowns are leaving the equation. Remember, uncertainty is a key driver of what happens in the markets. When we see uncertainty, we see fear pick up. When we see fear pick up, we see something like the VIX go up, stocks come down, money start piling into treasury yields and safe haven assets. That's how all of this works. And right now, what we're seeing is risk is leaving the equation. Why? How can we say something like that, especially with crude oil trading $93, up about 3.25% today? We're going to talk a lot of oil here in just a second. How could all of this uncertainty just suddenly be leaving? And it's not because the uncertainty of the war is leaving. It's because people are getting used to the concept and the idea of the war going on for an undisclosed period of time, and they're sort of okay with the status quo. And what I mean is we're used to the idea. All of a sudden, those unknown unknowns that a lot of folks we didn't have any idea what was going to happen in the markets, those are leaving. And we're starting to get an idea of, okay, this war is going to end. And it looks to me like there's going to be some sort of resolution. I'm not sure when. I would be surprised if we're still fighting here by the end of May. But it looks like another month, more than likely. And I think you're seeing deals crafted right now. I think there's a lot going on. And it's prima facie evidence. This VIX is very important. Okay, big month here. You can see we went to those highs, came right down to a doji, and then we sold off big, 1941. I mean, that's absolutely huge. If you want further evidence of are things getting back to normal, take a look at your gold market. Monthly chart for gold, right? We've sort of harped on and on. I mean, I covered gold so many different days. I'm getting a lot of negative feedback from gold traders right now saying that it's really, really tough to trade gold. And I agree. I agree completely. Gold is chop city. Take a look at where we're at for April. Extremely tight range. We're up about 1.5%. You're looking at the 22nd day of April right now. April's almost in the books. We're starting to think about May's trade. And when we're looking at the gold markets, that is an extremely tight monthly range. And just one of those things that I really would say is really almost impossible to trade it, especially if you're a directional trader, if you're trying to take longs or you're trying to take shorts. Gold is in an absolute stalemate. Let's pull up a daily. I'll show you exactly what I mean. This is trading in a phone booth. I mean, this is trading in a phone booth. For this gold market, and as volatile as it's been over the past year or so, take a look at this. That's April 1st. That's a phone booth, meaning price is in a state of equilibrium and it's right around 47.50. So when we start talking about, how do I trade gold? Can I get involved with gold? What do I think about gold, Shane? What side, bullish or bearish? Every single one of our key events, whether it's CPI, NFP, FOMC minutes, when everybody tunes in, we get a lot of traders in that aren't with us every day, and they come in, and undoubtedly that's the question that we get by far the most often. Gold, bullish or bearish? Gold, up or down? Buy or sell gold? And I look at it and I go, there's really nothing to say about it. There's nothing to say about it. This market's absolutely flat. It's a dead fish. It's not going anywhere until we see probably a resolution of the war. We're going to have to see the dollar move. We're going to talk more about that later this week with Kevin Warsh now testifying in front of Congress. We're getting ready to have a new Fed chair. What happens to gold if the U.S. dollar loses some puff? If those rate cuts come back into play? Well, what happens if they don't come back into play? What happens if all of a sudden the war rages through this summer and we get into rate hike territory or we can't cut interest rates? That's the only thing that's going to move gold. And right now, this is a great example. I mean, this is evidence of just how tight this market is. I mean, how do you trade in an environment where there just isn't anything there? I mean, you're up here, you're down, you're compressed inside day, another inside day spike, inside day spike, up, down, inside day spike. I mean, you see what I'm saying? There's nothing there. So when we look at our gold market, I would really be probably not trading this thing. Now, a couple of things that we do have, the ADR, the 13-period average daily range, has come down nicely, so I'm starting to really enjoy that range. Probably we'll be looking to attack gold, maybe with a reversion strategy or maybe something like that. But as far as playing a breakout, I don't think that's the idea. I don't think that's the right idea. I would be on the sidelines here. I would be waiting patiently before I did anything. You'll notice price is trading right at our daily moving average, 13-period EMA, and our weekly 13-period EMA. This type of compression right there, that's an absolute huge deal. So something like this, you see spike low, spike high, somewhere in that zone. Probably looking for a little disequilibrium. I want to move down to about 45.88, maybe 45.90. That could be a pretty good trade, and that we're about $130 off of that. So you're going to need to see some negative price action there to have an opportunity potentially to bid that thing. So when we're looking at gold, something like a gold type of a trade, I'm not interested in doing anything right now. If you want to trade some ranges during the day, maybe wait for this opening 90 minutes and then play a reversion type of a strategy, you can do it. You'll see what we had today. Right there is opening bell, ding, ding, and sort of a little bit of a sell-off here in gold, but it just isn't that much. 47.61 down to a low right down there, right around 47.23, and somewhere in this zone. I mean, we could put a Fibonacci on there if you wanted, maybe for an intraday trade. To me, I think that it's high risk. I wouldn't be playing a trend today because it just isn't there. It just isn't there. If you wanted a late day trade, maybe somewhere right up in here, 47, 46 sells. That's a possibility. But the rest of this, I just don't see any need to get involved. We want the big trade. We want this thing to break. Give us a shot down here, maybe to buy right around 45.90, somewhere in this zone. Could be a pretty darn good long trade for gold. So that's a good look at the bullion markets. I think it's an incredibly challenging dynamic. I don't know that I would be interested at all in trading gold right now. I just don't see it. I think it's absolutely, I won't call it a fool's errand, but I think that if you're trying to trade trends and breakouts in the gold market, I think you're having a really hard month, a really hard one. That's for sure. All right, we got a few things to cover here today. Remember, if you want to trade anything that we talk about, any ideas or anything of that nature, head on over to switchmarkets.com. They'll get you up and running with thousands of global markets, tight spreads, zero commission accounts, you name it. They've got it over there. So that's exactly what I'd say, 1 to 1,000 leverage, probably depending on your municipality, $50 minimum deposit. They've got all sorts of matching bonuses going on right now. So if you're a new trader, be sure to go on over to Switch, click on that live chat, quick start guide, go ahead and ask a question, and they've got a customer support service right there waiting to get you signed up and ready to rock and roll in the market. So what we want to talk about today is I want to break down some key events. I want to start off with a trade update that we put out earlier. We had a few levels come into play, though, in the Great Britain Pound USD and the Euro USD that I was sort of harping on before we went on vacation, and I want to show you those levels because they both work like a charm, and that really is typically how it works. We go through tough cycles, and then typically when you step away away from the markets, you see all of your levels come into play, and they all pretty much cash. So maybe that's the state for automation. Maybe I'll be automating my trade soon. I've always steered clear of automation since about 2013 and 15 through 15. But maybe it's time just to automate and let these levels run. I don't know. You wonder about, what might have been if you'd have stayed around and maybe not taken a vacation. A lot of the old traders, especially the pit traders, they used to talk about that a lot. They'd say when you step away from the markets and you go on holiday, you don't really want to be on holiday because you're thinking, man, how much money could I be making if I was still there trading? Now, the electronic markets are with you anywhere you go. We don't have trading pits now. We don't have just open outcry pits, so you don't have to go to the Chicago Mercantile Exchange or the NYMEX or the COMEX or any of these old-time pits because they don't exist anymore. The trading pit is right in front of you. It's on your computer. You could have a nice laptop you take with you with auxiliary screens and trade from anywhere in the world anytime you want. And that's great. And that's great freedom. And maybe the way forward is to do just that next vacation, maybe just spend a couple hours trading. But I like to step away from the markets. And when I step away from them, I step away from them. I put them down. I don't look at my charts. A little bit of news here and there to try to catch if something really big happens. But as far as what we're looking at on a day-to-day basis with levels and technical analysis and all of it, I don't do any of it when I'm away from the market. And that's important. You need to be able to recharge. This business will grind you down, especially if you're an intraday trader. This business will grind you down because it will exhaust you, and you've got to step away from it to recharge your batteries, even if it's for a 3-day weekend here and there, even if it's for a week, maybe a month, maybe 6 weeks. A lot of the big-time traders, they take seasons off. They'll go hard. They'll go hard through Q1 and Q2. Then they'll take a chunk off in the summer. They'll come back and trade the fall, and then they'll go away for the holidays. Every one of us wants to operate at that level, me included. I would love to operate at that level where I'm just only really trading 4 or 5 months a year and still doing what I need to do to make it. Most of us on this live stream can't do that. We're retail. We're looking just to make money where we can make it, and that means we've got to be in the saddle as much as possible. So if you're in every day and you're making trades every day and you're looking at 5-minute charts and 1-minute charts and not 20-minute charts, but maybe 30-minute or 4-hour charts, and you're in this stressful environment, day in and day out, you've got to shut it down and you've got to take a break. So when I take a break, typically I go to the beach. I'm looking for sand and something cool to sip on and great food. That's what I'm looking for. And if you do have an opportunity to get away from these markets, I highly suggest you put them down for a while, even if it's just to stay around the house and maybe hit the gym, maybe mow the lawn, whatever you got to do. So that being said, I want to see everybody smiling by the end of Q2. I think we're going to be in a great position to do so. T. Marino, welcome back. Shane, how was my vacation? It was great. T, down to Florida, flew into Jacksonville, went down to a place called St. Augustine, really a neat little town, and then spent a few days down at Daytona Beach. If you're in that area, all right, that's fine. Daytona was just a little bit too busy for me. I was down there years ago, and it has really grown and really changed since I was there last. So still a great time, though. A lot of fun. Had a great place to stay. Had a beautiful view way up in a nice condo. So I can't complain. It was fantastic. Travel was a little bit tough on the way back, but I don't mind. I don't mind sitting in airplanes. That's for sure. I don't do it very often, so when I do, I just sort of very patient. But it was good. Daniel, good to see you. Daniel, welcome. I'm doing very well. Glad to see you back. By the way, I watched the movie Into the Pit. The guy on the piano. Yeah, I'm trying to think. His name was Rebus, wasn't it? I think his name was Rebus. But, yeah, the guy on the piano in the movie, if you don't know what we're talking about, you can go check out The End of the Pit. But, it's funny because here was a guy that sort of got washed out of the CME, and you look at him, and the guy's still playing this grand piano, so he still had something. Drinking fine wine and playing a piano, so that's for sure. But yeah, I'm glad you checked that out. I like that movie. I think it's great. Let's see. Ralph H. Good to see you, Ralph H. Welcome. Doing very well here. Cannot complain. Sunny Florida. I've been here 3 years, and I love it. Really, Ralph. I tell you what. I could probably live up in northern Florida, I think. I think I could probably live just right outside, just south of St. Augustine. There are some really nice places there, nice beaches. I was looking at a lot of the condos down there. They got the condo bubble really has burst. Some of the prices they were selling these things for was just dirt cheap compared to up here in Montana, and I was really surprised. But they say the HOA fees can be a bear. But I could easily see myself trading out of a condo and hitting the beach every day, at least for 6 months of the year. I could see that. Let me see. Yeah, Daytona. Went to Daytona and Myrtle Beach for Bike Week. Everybody packed like sardines. It's funny because we were down there, and this week was Jeep week. So we were down there last weekend, and they already started. The Jeeps started coming in. So we sat there and we had this sort of a front row view of these guys driving their tricked out Jeeps up and down the beach. So if Bike Week is anything like Jeep Week, it is packed. It is absolutely packed. There must have been 20,000 people at the beach, and we had a great view, so we could look down the beach each way. There was more people there that are in this than in this entire city easily where I live. So it was a lot of fun though. A lot of good people watching. So I really like Florida. Traffic is a bear. Driving down 95 is always tough from the airport. I don't know. I'm not real good in traffic. I drive here in Montana where you see another car, you wave to them because you probably know them. All right, everybody, let's go ahead and get to it. This is the big news story today. Strait of Hormuz remains basically closed as Iran seizes ships after Trump's ceasefire extension. What do we need to know here? Well, we need to know that there's still problems in the strait, and they're still trying to work it out. The U.S. has set up a blockade. I watched some video yesterday of the United States. I don't know if they're special forces, but the troops, they were landing on oil tankers and taking them over. So there's a lot going on. Supposedly, Iran was firing on cargo ships today. That's been an escalation that's sort of driven sort of what we're seeing here in WTI Crude Oil, which has brought a little bit of bullish participation. Really an incredible strike on a monthly support level. But you can see the last 2 days been fairly bullish. So yesterday we're up about 5%. Today we're up about 3%, trading right around $93. It's bullish. No question about it. This crude oil market is still very bullish. There is some reason to believe that if this war does get settled, though, there could be some bearish market drivers in there. We're going to break those down for you in just a second. But let's go ahead and start off with a trade update here for Bitcoin. I want to get this one out of the way because it's sort of coming our way relatively quickly. We had a big rally in Bitcoin, sort of a breakout while I was gone, broke away from that 70 level. That was just a huge compression zone that we had seen price trading between that 62, 50, 65, and 70 was sort of a dead fish. And now it's broken out. And there's a couple of reasons it's broken out. I sort of put this out in today's trade idea that there was a story that, what was it, Michael Saylor from MicroStrategy. They said they accumulated $2.5 billion worth of Bitcoin. So sort of suggested that the institutional money was diving into Bitcoin. We know the Trump administration is deregulation. And if you deregulate the crypto industry and you get institutional investiture, then you're going to see crypto blow up. And that's sort of what we're seeing. I'm watching crypto closely. I wanted to buy in. I really want to buy in. I'm not sure just yet until this war thing is settled and we get the helium and the semiconductors and everything moving smoothly, where we can bet on really the AI boom taking over and driving crypto to new heights. And that's essentially what we're talking about. We're talking about really a rally in AI and also a big time rally in cryptocurrencies. I believe that they really are hand in glove. I think that if you see AI continue its trend upwards, like Bobby pointed out in the NASDAQ, you're probably going to see some good stuff here out of crypto. So big picture, Bitcoin's back up to around 80,000. It's been really in a log jam. Hasn't done anything. I wasn't even pulling my crypto charts because it was so dead. Now we got some movement. So I got a nice resistance level in play. I think it's going to be coming our way relatively soon. And this is sort of a monthly 62% level right up around 83, 420. We're not looking for much there. What about 30? I think it was 3,700 pips or something like that. So you're looking to dig in. You dial your leverage way down. This probably would be a pretty good play for like a micro Bitcoin futures contract or a BTC CFD, but you can do it with the BTC USD. You just got to dial your leverage down, because the stop out, you're probably not going to want to stop yourself out until like 86. You're going to want to give this one room to breathe, because the bullish sentiment is there, but still not, the Middle East situation's not resolved. And if it's not resolved, then we've always got the threat of the helium issue, not getting the helium through the Strait of Hormuz, which is key in building the chips, the semiconductors. It's a key coolant in the process. And if you don't have the helium, you can't build the chips. And if you don't have the chips, you can't expand the AI. And then all of a sudden, questions start to surround everything to do with quantum computing, which is very much what Bitcoin's all about. So this is fascinating stuff to me. I think we're looking at about 83, 420. Could be the top of this current wave. Right now, we're banging up against this 50% level at 78.9, 79,000. So this area right here, a lot of people believe it's key. I don't do 50%. It's not my bag. Not my thing. I don't do it. But you do see that if you have an opportunity there, maybe to short, step up and short. I think we're in there about 80, 82, 82.7, something like that, 82.750. Probably a pretty good trade. So I'm going to be watching that closely as we sort of dive in or move further towards summertime trade. And then also Shiba. This was one that I sort of hinted at that I really liked this one. This was a pretty good market. I thought that we had an opportunity potentially to take a long-term investment from this level. Haven't done it yet. I promised full disclosure that when I dove into Shiba, I would tell everybody, it's so easy to spot these things and then come back and say, oh yeah, I bought down there. Well, I didn't buy down there. And the reason why is the semiconductor issues coming out of the Persian Gulf and the actual war itself sort of scared me off. And I have no shame in saying that. When I feel like I don't know something, I don't worry about it. I say, well, let's just wait. Typically, waiting is the right answer. Typically, waiting is almost always the right answer. A lot of guys that have made millions would laugh at me and say, you're just not aggressive enough. And I'd say, well, maybe not. But you can see down here, this area right around this spike low that was established back in June of 2023, right down around 55. Beautiful stuff. We had a nice sell-off there. Back in February, the low was 50, and we've sort of crawled back over 20%. So if you got those lows, you're up 20%. That's pretty good. I mean, that's a pretty good move with regards to just a nice investment. But this would be a buy and a hold for me. I like Shiba. I like it for a lot of reasons. One of the reasons why is because it's at such a devalued level. It's trading near its all-time lows, and it's debatable whether these things are worth anything at all. I mean, really, but what we're looking at is we're looking at something that has notoriety, that's been around for a while, and it's trading at a very depressed level. So in my view, as the money starts flowing back into crypto, I sort of look at Shiba like a pink sheet stock. It's not quite, I don't think it's going anywhere. I don't think it's going to just be bankrupt overnight, but it definitely is one of those things that's extremely cheap. It doesn't have much of a valuation, and that's going to attract a lot of retail money, especially if that crypto sphere keeps moving higher. And I think that's what we're starting to see. I'm not fully ready to jump onto the bandwagon just yet. Bitcoin's got some challenges up there. 80 is going to be a challenge. That 83 level I showed you is going to be a challenge. But institutional investiture and also crypto deregulation, those are big time catalysts for bullish participation in the entire crypto sphere. That really spells an incredible top side. But the war is a drag. It is a drag on these things. And right now everybody's like, do I really want to pile into Shiba? Not yet. I'm waiting. Still, though, it's up 22% or 25%, almost 25% from those lows. That's for sure. Let me see, Daniel, but there will be no data centers with wind and solar. You guys need nuclear if you want to make this work. Not going to work with green. No, you need more juice. I mean, that's the absolute bottom line. I don't care what anybody says about data centers and AI and all of it. You need juice. And what that either means is you've got to just have dedicated hydroelectric dams that are powering these things, which is never going to happen. You could go clean coal. You could burn a ton of coal to try to get the power. Once again, that's never going to happen. LNG. That's why some of these data centers were going to be built in the Emirates, the UAE, because the LNG resources they're out of Qatar, we're going to power them. And now all that stuff's in doubt because you don't know what's going to happen there. But you're definitely right, Daniel. You're going to be looking at nuclear. Nuclear, they're going to build those tiny, small, they're not tiny, but they're very small scale nuclear power plants. And those are going to be juiced right into the AI centers. And that is going to be what powers this whole thing. Andrea Garwell, good to see you, Andrea. Welcome back. I sure appreciate it. Thank you for the warm welcome. It's great to be back. It's good to be back in the saddle. I think it's going to be a lot of fun. I really do. I like what's going to happen here. The rest of maybe not so much this month. It's going to take me a couple days before we start getting the money back in play, but that's just my own habit. After taking some time off of the markets, it's about getting a feel. Got a pretty good feel today, though. Got a pretty good feel. So I really like next week, and I love May. May is always one of my favorite months to trade. It's a good one. It really is a good one. So I'm looking forward to it very much. Let me see. What is the use case for Shiba Inu? None. A use case? We're not talking about use case. Use case, I don't know. There was a time when I thought it was going to be a tipping mechanism on X. I thought that they were going to be using Doge, Shiba, everything off of that, sort of off of that Elon Musk, not a blockchain, but sort of off of that tree, the Musk tree. You were going to have X, and then you were going to start tipping content creators on there using the crypto. I thought that was brilliant, and that could definitely bring some value to Shiba. That hasn't happened. And I was calling for that 3 years ago, 2.5 years ago. So does it have a use case? No, it's highly speculative. But, what else? What's Bitcoin going to be used for? It's just a bunch of rich guys trading Bitcoin right now. How many do you have? How many does Jamie Morgan have? How many does Microsystems, MicroStrategy have? These guys are just comparing the size of their Bitcoin holdings. That's all they're doing. Is Bitcoin ever going to be worth? Is it going to have a use case that is even remotely scalable? I don't believe so. But that's just me. But then again, I'm older. I'm not quite a boomer. I'm not a boomer, but I'm definitely. What was I, 70s kid? So I've been around. I don't really see the use case for any crypto, but the technology is fascinating and the hype is definitely there. And I don't really care if they use it for anything or not, if the price goes up. I mean, that's what we care about. So maybe that's not the best attitude to have, but it's the one that I have. So that's for sure. Running on one node. Nodes. Who cares? Who cares if you buy it at 6 and it goes to 12? Who cares what it's running on? All right, guys, let's go ahead and get into some of our fundamentals, and then we've got a lot to talk about here on the markets. We had a couple great levels come into play for our majors, Forex majors. Week 17, you can see sort of Iran wars. Every Monday is going to be weekend developments, Iran war and Trump announcements. That's going to be the number one thing on a Monday open until the war's over. Tuesday was retail sales. Came in pretty good, not great, but definitely showed some signs after really a brutal beginning to the year for retail sales. Today was UK CPI and EIA crude oil inventories. That's what we're going to cover. Tomorrow's initial jobless claims and the S&P global PMIs. The initial jobless claims numbers may gain a little bit of importance just because there's a lot of folks out there that believe you could be seeing the onset of a recession. I don't really know if that's the case. And then you've also got Friday's No Donation Friday, very light news day Friday. Very, very light. So as far as our news today, you've got UK CPI, which came in, I don't know, I'd say in line with expectations. The PPI input month-over-month March was really the big story here, coming in at 4.4%, over 2.9 expected, and way up from the previous month. We got to wait and see if these numbers stand, though. They may be revised down on the next release there out of the UK. You've also got CPI month-over-month, and that came in at 0.7%, a little bit above expectations. So inflation is an issue in the UK. That shouldn't surprise anybody. Because of the price of Brent crude oil. Right now I'm watching Brent crude trade at about 101.87. So that's definitely inflated from where we were the previous month. So these CPI figures, I would sort of take them with a grain of salt, but you could see this Great Britain pound USD, this was a level that we had lined up, sort of teed up before we broke for vacation there, but 136 even. Spike high there, 138.70 down to this low 131.59, and your 62% was right there at 136. Absolutely loved 136. Thought it was one of those that was an absolute banger. Great resistance zone, and you can see on your daily, this one hit a few days ago, but there it is, back on the 17th of April, and you see your high right there is 135.99. So it doesn't get much better than that. You can see it sort of had a triple top up there, 135.90, and then you came off a little bit, went right back up there to 135.95 and came off, and then right here you saw 135.99, and then you got the big reversal down here right into the 134s, 134.75-ish. Pretty good stuff. Pretty good stuff. I love that level. I think it was a fantastic zone. You can see basically the same market dynamic out of the EURUSD. We had a high right here of 120.81. 120.83. These numbers aren't quite exact. I guess I could dial them in for you exactly, but really a hard strike on that 62% level. The back end of the golden zone, which I'm a big fan of. Love the golden zone. I think it's always a lot of fun. Let's see the low right there, 114.11. Pretty darn good range. And right there, you're about 118.26. So this wasn't as pretty as this Great Britain pound. That level right there at 136 was fantastic. Big round number, key resistance zone, Fibonacci level. When those things line up, I mean, it's just like making a stew. Just making a stew. You get some good ingredients and you stir it up, and all you need is price action to hit your level, and you're in great shape. This is fantastic. Right there, 118.25. Not bad. Your high up there was 118.49, so the trade was very doable. And the big sell-off of about 100 pips since then has been pretty good stuff. And you'll notice how the trade sort of unfolded. Multiple tests of that zone. There it is. Right there, big test right there, 118.23, went a little bit higher and then had the big reversal, sort of that inverted hammer formation. Talk a lot about on a daily. and then you see the big crash right there. So as far as what do we do now with the, like say the Euro USD and the Great Britain Pound USD, well, I mean, there's a couple of things we could do. We could go to a weekly here and look to bid. I really don't have a problem with that. I really don't. You see we've got that key level right there, 38% on the monthly. This is sort of an advanced Fibonacci sequence that probably is going to confuse a lot of people, but what we're looking for is just a little bit of not necessarily confirmation, but we're looking for these levels to come together. And you can see right there, spike low to a spike high. There's your pullback, 116.92, maybe 117. Probably pretty good for a little bullish scalp, 25 pips or so. That wouldn't be bad. This area down here, though, is pretty good. That area, that monthly 38%, along with our daily moving average, 116.75, 116.67, more than likely, I would be focused on that area as opposed to just playing this as being really a breakaway trend, because it's not. It's a big week there. I'm not going to argue that. Pretty good week there, and now we're on a pullback. Do we expect to go higher? I do. But it really depends on what happens with the war. Right now, it really does. We've also got Kevin Warsh is in front of Congress. I'm going to cover that tomorrow. We're going to break down the questioning and what we think Warsh is going to do as the new Fed chief, and when he's even going to be seated as the new Fed chair. I mean, we're down to the final days of Jerome Powell's tenure. He's got one more meeting, I believe, and then he's to be replaced. But we're going to learn a lot here in the next week or so when Powell takes center stage. That could definitely shake these pairs up. So we're going to be watching that closely as well. But this area right in here, this zone, pretty good stuff for a buy. So I'd be looking at that 50%, or excuse me, that monthly 38% level, 116.75, 13-day EMA. I like that. I like that. It's pretty good stuff. As far as our other news of the day, crude oil inventories came out. EIA crude oil inventories came in at 1.925 million. I saw 1.7 earlier, but it's negligible. 1.925 million. That was way better than expected. We expect these supplies to begin dropping because of increased consumption out of the domestic stockpiles due to sort of a slowdown in the global exportation of crude oil from the Persian Gulf region. So the Strait of Hormuz, as it stays closed or cold or whatever you want to call it, that typically is going to put a huge drag on global oil supplies, which the United States, I mean, in the Trump administration, is more than happy to subsidize. They're more than happy to export more U.S. oil abroad just to try to make up the shortfall. So I would start looking for these inventories to fall. They're not falling. So that tells us that the working wells, the wells that are in operation here in the United States, are starting to really pump. And I think that's fantastic because you need as much oil as you possibly can in this situation. So we had a nice big bump up there, but this is the key. And really what I would look at is the third paragraph of that EIA report. And this is what's key. U.S. commercial crude oil inventories increased 1.9 million barrels from the previous week at 465.7 million barrels. U.S. crude oil inventories are about 3% above the 5-year average. We haven't seen that in years. We have not seen that in years. That's absolutely huge. We're starting to see this trend be a real build. I mean, if you take a look sort of at this chart right here over on Trading Economics, here is your weekly crude oil stocks change. Crude oil stocks change over the past year. So you had Trump get in somewhere back here. So we had some drags, some downturns. But take a look at this trend. I mean, essentially, once the war started right in here, right at the end of February, we had this massive build of about 15.9 million. Maybe somebody knew something was coming. Typically, the smart money does know about things before they happen. But there you go. There's your big build. Then you got something like this. Then the next week, still just solid builds. And then right there, you've got sort of a downturn there of almost 1 million barrels. And then you're back up this week. So this stuff right in here is absolutely huge. Absolutely huge. It looks to me like the United States, the producers are committed to pumping more oil, not necessarily drilling for more or getting the exploration going for more, but they're definitely interested in pumping more. And by doing that, you're pretty much going to make sure that at least the U.S. stockpiles aren't necessarily compromised to a great extent. However, this type of trend could be a big bearish market driver for U.S. oil. And the reason why is once this war is over, and I believe it's going to be over very soon, within a month, once there's a settlement reached or once the war is over, you could see crude oil absolutely plunge going into the summer months. So right now we're trading 93s for U.S. oil. I think that you could easily be trading 68s over the long term, and I think that probably would be my downside target. But the war has to be wrapped up first. If it's not wrapped up, you're going to have a real problem. So why do I say 68s? Here's your monthly chart. You're going back to December's lows, coming off of 2025, and you see there was sort of the big bullish move there, 15%. A lot of that had to do with a weakened dollar. Then you sort of had the hold firm month, and not really much going on. And then there's your war month, and there's your gap right around the 78% level, right at $68. In my view, that's probably where your post-war crude oil is going to be trading within probably 6 weeks, or that's way too long. Not from now, but let's say the war's over tomorrow. I would say within probably 2 weeks of the war being over, we're going to be trading right down at the 68 level, and that's the reason why you could be looking at that. Is number one, the Fed's not going to be able to cut rates as aggressively as they wanted to. That's going to mean a stronger dollar for a little bit longer. That's bearish for crude oil. And then also the U.S. has stocks. Now all of a sudden the U.S. has some supply. That means that, okay, maybe crude oil is not going to just absolutely explode. And then once the global oil supplies return to where they are, where they were pre-war, which could take some time. But remember, we price oil out a few months in advance. So we're looking at something like this saying, yeah, you're probably going to be bearish. One thing that jumps off of this U.S. oil chart to me is going to be this right here. This is a nice sell-off and then a hard strike right there at 79.50. 79.50 and a big bounce right up to 93.10. That has happened in April. So the Fibonacci sequence is very real here. This is a great range to be working with, and I'm watching it closely. Right now we're back up. I wouldn't say you're quite in extremely bullish territory. That's going to be right up over 94.72, somewhere around 95, but somewhere right in this zone, 93. The markets are in wait-and-see mode. I hate to say it because it's so incredibly negative. And we started to get really bogged down in the negative issues surrounding this war before I left a couple weeks ago. And it was easy to do because we saw that it was going to take a lot longer than a lot of folks believed. They thought that the war could be over very soon. That's not happening. It's still going. It's not happening. But there is reason for optimism here. There is reason for optimism. However, and I hate to talk in circles because I really don't know what to say about the Middle East that hasn't been said by everybody else. People are waiting for something to blow up. They're waiting for escalation. They're waiting either for an oil tanker to be sunk. They're waiting for maybe a U.S. Navy ship that's around the region to get hit, waiting for a ground invasion out of the United States. That type of escalation is why crude oil is still trading right around 92.50. The ceasefire has been extended. Trump extended the ceasefire. They're going to go with this blockade strategy for right this minute. Does any of it work? Maybe, maybe not. This is still very bullish for crude oil. Very bullish here. Above $90. The big guys are just in wait-and-see mode, and it's obvious by the charts. Even though technically we're not in extreme bullish territory here for crude, you're still very bullish. One thing happens, one bad thing happens, this market jumps right up about 105, 110. The upward trajectory is definitely there. It's definitely there. So definitely want to tread lightly here if you're shorting crude oil. However, we can build the case that this market can absolutely crater, and I mean absolutely crater, once the war is resolved. And with the U.S. pumping as much oil as they're pumping right now, we could see WTI crude and U.S. oil really plummet in a big, big way. Now, UK oil, different situation. Same basic market dynamic. I mean, you still see the great big rush up. The key level is 100. No question about that. Absolutely no question about that. If we're going to use the same Fibonacci sequence here for Brent crude, you certainly do something like that. You'll notice that it wasn't an exact strike on 62%. However, you're way above 38%. So Brent crude's getting hit a little bit harder. It's getting hit a lot harder than WTI is. You'll notice that spread is back in effect. Remember, WTI traded at a premium for a while over Brent. That's unheard of. And now you've got Brent back up there, UK oil at $102 a barrel, and you've also got US oil at 93. So that's back to normal, it sort of looks like. And the reason why is your global supplies are really being restricted out of the Strait of Hormuz. I'm looking at 75. War's over tomorrow. Oil stocks start getting back to where they are. The supply lines are back to where they need to be. You're probably going to be seeing UK oil trade at 75, crude WTI trade somewhere around 68. That's my bet post-war. That really is. And that's going to bring a lot of questions in. It's going to bring a lot of questions because you're still going to be relatively high to where we should be with regards to where we were, last year. Still going to be relatively high even if we trade there. So the crude oil market's going to be interesting, but all of a sudden, you're starting to see that negative correlation, that inverse correlation. When WTI goes up, stocks crash. We're not seeing that. That tells us that maybe there's a resolution coming our way, or maybe we're just waiting out this ceasefire, and a lot of folks are getting in position for the post-war world already. If you're buying stocks today, similar to what Bobby Bob was saying with the US 100, if you're buying tech today, you're betting that we're going a lot higher. And this is fascinating stuff to me because we broke up around 27,000. I forgot a zero there. 27,000. We're getting established, and we broke out above 25,000. It looks like Elvis has left the building for right this minute. You're cracking all-time highs. You broke through what was just a significant double top right up there at 26,250, and now we're gone. So, it's really tough not to just start buying stocks, buying tech, waiting for the next big level. However, we don't have to do that. US 500, you can see that is definitely above that 7,000 level. We were watching that closely. That's above that 7,000 level. That's huge. It's absolutely huge. How about the US 30? US 30 is sort of the laggard here. Now, this was a beautiful trade. There's no question about it. The panic lows, the tariff panic lows of last year to those highs, pre-war highs. There's your war month, boom, and there's your rebound month. Right off of 38%, and now we're driving towards where? 50,000. 50,000. Stocks are incredibly bullish right now. Incredibly bullish. And given this market environment with crude oil trading where it's trading, it feels like there's going to be a solution to the Iranian situation here relatively soon. So I'm starting to see the light at the end of the tunnel here, whereas if you talked to me 3 weeks ago, I'd say there's no end in sight and this thing can go any which way but loose. And right now, we're starting to see the light at the end of the tunnel. And the stock traders are not lying to you here. They're voting with their wallets. They're buying. And the only reason you're in there buying the US 30, the US 500, and the US 100 is because you believe that the markets aren't just going a little bit higher. They're going a lot higher. People are already trading the post-war environment. So as far as what can we do right now, very dicey, and it's highly risky because anything can really scare our valuations. But this is textbook. I mean, this is a pullback. Didn't even get to 38%. Could not establish trade beneath our 13-period EMA. I mean, in a lot of ways, the sell-off of the tariff panic last year, now you got the big rally, and then you got a little war panic, and we're just going higher and higher and higher and higher. It's an incredibly bullish environment. We'll see what happens. One last market here to look at, natural gas. I talked about this level forever. Of course, it goes when I'm gone, but you'll see right here, really a nice strike back on the 10th of April, and then we just bounced right back up the next day. Really a great move, 27.35. Came down, traded a little bit lower, right around 25.69, and then a big rally here. And now it just looks like we're bullish. I don't really know what to make of the natural gas market. A lot of folks were just saying, oh, gas. I mean, what about natural gas in the Persian Gulf? And I go, you can say what you want about it. It didn't happen. And remember this, when you listen to the talking heads on TV, or if you listen to podcasts, if you listen to my live streams or whatever, we can put out ideas and hypotheses. Natural gas should have spiked with that kind of heat being put on the LNG facilities in Qatar alone. The LNG, the natural gas coming out of Iran, coming out of the entire region. It did not happen. It did not happen. So when we're looking at global natural gas, much different scenario than WTI crude and UK oil. I mean, it really is. So when we're looking at this situation here, nice bounce off of 2025's lows. We sold off a little bit, but it looks to me like this was probably your buy signal. This doji coming right back up over 26.39. But this trade idea was just a real tight scalp. Tested that low, bounced up. I mean, it was really a great trade. And, of course, these things happen when you're out of the office. That's just the way that it is. It's the way that it is. Let me see. All right, let me see. Good to see you. Well, I got a little bit behind. Hi. Will the Great Britain pound news have any impact on the Euro USD? Maybe a little bit. Maybe a little bit. We saw the UK CPI come in a little bit hotter than usual. That was to be expected because of the Brent crude. But as far as, is there a strong correlation between the Great Britain pound USD and the Euro USD? I mean, typically it's going to be more dependent on the USD. So if you see something that really shakes up the Great Britain pound, you might see a little bit of short-term turbulence in the Euro USD. But typically, You see just from today's action alone, really tight here. This Great Britain pound trade, really, really tight. Euro USD is coming off. So to me, no, I wouldn't hang my hat on that at all. Well, I would treat them. I would always be looking at my majors pretty much through the lens of the U.S. dollar from that perspective. I think that's very important because I don't want everybody to go in and say, okay, I've got a position, the Great Britain pound, the Euro USD, the Canadian dollar USD, the New Zealand dollar, because you'll find that over time, it's just all about how the USD performs as opposed to, okay, is the Kiwi doing something different than the Great Britain pound and then the Euro? Yes, but in this environment, given this war type of situation scenario, you're probably going to see those march, not necessarily in tandem, but it's going to be more dependent on what happens with the United States dollar. Now that's barring any sort of big event like a central bank announcement or something like that. So like let's say you had the Bank of Japan announce something one day, then yeah, you're going to see different action in the USD Japanese yen than you will in the US dollar Canadian dollar. So that's definitely keep an eye on your economic calendar. But as far as is the Great Britain pound and Euro USD, is one going to impact the other? Maybe, but I wouldn't be hanging my hat too much on that. I hope that helps a little bit. To me, I would just keep an eye on that economic calendar. Local events, of course, are going to be big deals. You're going to definitely want to know when central banks are talking. But as far as your big events, the ones that really shake up, I mean, you can count them on two hands. You're going to see central banking activities from each country. That's going to shake up your majors independently of one another. Meaning, when the ECB talks, that's going to impact the euro. The Bank of England, the BOE, that's going to impact the pound. But does the BOE impact the euro when it speaks? A little bit. Is it a huge deal? Is UK CPI shaking up the euro USD? Not really. Not really. Let me see the German thing. So was there German GDP out? I didn't even see it well. Must have been, yeah. Sorry, I don't follow you. You can specify a little bit more. I'm more than happy to help. Babgees, welcome back, Shane. I almost thought you went AWOL. We just decided to run off to the beach, hang out, get a tan. I thought about it. Sell the Canadian dollar. They could. Daniel, I feel the crash incoming. Seriously, throw PR rations are totally overvalued, and Berkshire is out stockpiling cash and 3 months T-bills. He's waiting for a discount. Oh, PE ratio. PE ratios are totally overvalued. Yeah, I mean, I hear you on the stocks. I think we're in a new era, Daniel. I think we're in a new era where the impetus is going to be to devalue the dollar to keep stocks high. And whatever you think about that hypothesis, I haven't seen anything over the last 4 years or really since COVID that's told me that the powers that be and the people that are responsible are ever going to restore the value of the U.S. dollar and try to really curb inflation. To me, well, I'm going to show you a couple charts. This is about as easy as I can make my argument. This is it. U.S. dollar index. Said it a million times. Inauguration day for Trump. Immediately, the dollar started getting devalued. Why? Because we knew that rate cuts were coming. We knew that the Trump administration was going to bring more debt into the equation to try to grow the economy. That was the idea. What does a devalued dollar have to do with the rest of our valuations? A lot. It has to do with, this right here is why your gold pretty much is where it is. The idea that, okay, we're going to inflate our trouble away. And a lot of this was really the unwillingness of the United States Federal Reserve to take aggressive action after COVID to restore monetary policy into a place where it could manage inflation aggressively. It can't manage inflation. Let's be brutally honest. Let's be honest. Inflation's entrenched. It's not going anywhere. So what Jay Powell and the Fed would say to you and would say to me is they'd say, well, we slowed down its pace of growth, though. Inflation's back around 2%, so we feel pretty good about our monetary policy. But they're not counting the giant inflation that happened right after COVID, and since then we've still been moving higher. What was needed, in my view, was something that we saw in the late 1970s, that tried to take the air out of the oil shock, the inflation out of the oil shock. And it was when Paul Volcker, the head chairman of the, not the head chairman, but the chairman of the Fed, came in and jacked rates up to about, 17%, I think it was, 20%. And they did it because you were looking at a period of stagflation. Your inflation was so high because we had problems in the Middle East with oil. It's deja vu all over again 50 years later. All right, so you did that. So you said, well, we got to curb inflation somehow. So they jacked interest rates way up. It killed everything. It killed your jobs markets. High unemployment went through the roof. All of a sudden, home loans, it was almost impossible to buy a house. And if you did, most of your money was going to pay the interest down, not the principal. And what that did, though, and what those high rates did, was it set the stage for what was going to happen in the 1980s, which was just a huge economic expansion once the pricing stability sort of got reined in a little bit. Now, we can argue that the inflation ebbs and flows and all that, but we haven't seen any evidence that anybody at the Fed wants to do anything to curb inflation with regards to managing the unlimited quantitative easing of COVID. Nobody wants to do it. Nobody wants to be a big boy. Trump doesn't want to do it. He doesn't want to do it. He wants lower interest rates. We're going to inflate our way out of this problem, and you're going to see the dollar maybe stagnate down around here, but our stocks are going to go through the roof. Well, there was another country that did that, and they did it after a big panic right around turn of the century. This is the Nikkei, right? I mean, there it is. Nikkei's exploded. Well, I mean, let's go back and really take a look at when the Japanese, the BOJ, decided they were going to adopt, a dirty float, keeping the yen devalued. What do you got right there? 1st of January, 2016, boom. That's exploded just in the last 10 years. And this chart doesn't even show us really the full breadth of the Nikkei. I mean, do we have anything? Just give me the index. Maybe something like this. Okay, there's your line chart. All right, we got a line chart, right? So this goes back to the 1950s, and you came into a situation where you had one of the biggest economic expansions in history. The Japanese really got it going, and then got it going right here in the 70s, and then the 80s, and then it got real tough in here. Got real tough. They had a big crisis right around 2000. I remember that. I was in college, and things weren't good. Deflation was the problem. So what was the answer? Adopt a dirty float, negative deposit rates, pump as many yen in the market as you can. Then fast forward right here, January 2011, Shinzo Abe, 2012, Abenomics. What was that all about? More yen, deregulation, get foreign investiture and grow the economy and your stock values from within. That was the plan. That's the plan for this. Yearly Dow Jones Industrial Average going back to about that same period. Boom, equities start flying, right? So that's after your liquidity crunch of 2008 to 12 scared everybody, drove a lot of people bankrupt, and then they started just pumping money into the markets. Right here, enter Donald Trump administration. Sort of some stagnant years. Pretty good move right here under Obama in 13. Unemployment back in here, though, was about, it was about 9%. Flattened out, and then you got the huge run up here. So what I'm trying to say is the inflation's entrenched. The U.S. dollar, if the Trump administration and Kevin Warsh, the new Fed chair, get their way, they want to cut interest rates, spur economic growth, send stocks higher. How they're going to control inflation by doing this, I have no idea. It takes us full circle. In order to control inflation while you're cutting interest rates, you can't have problems in the Middle East. That's why a lot of people believe this thing's going to wind down, and I'm starting to come around. There was a while there where I thought it was touch and go, and this was going to be potentially a major conflict for the next several years. I don't think that now. I think things are changing, and we see it by the price action in the markets. Everything can happen day to day. All right, one last market. Let's go ahead and sign off. You got the U.S. dollar, Japanese yen. This was a banger. Really came right down to our 13-week moving average, which was right around 157.55. You saw last week's low is down there at 157.59. It's exploded up about, 200 pips, which was a fantastic trade. This zone right in here, still love it. Still love it. So if we do see the U.S. dollar, the Japanese yen start to flex a little bit more against the dollar, then potentially we could have a very good situation down there. That 13-period EMA is right there at 157.77, and then you've got the 38% level, that long-term 38% level on the weekly at 157.31. That could be very good. That could be very good. So watching this closely, I think that this dollar yen may be a trade idea for tomorrow, but we are up. We're up big. That's 200 pips down the way, and without anything really to shake the markets up the rest of the week besides Trump and the Iran war, I'm not really sure that we would even get that kind of disequilibrium that would drive us to grab a bid from 157.50, that's for sure. So if you feel the crash incoming, Daniel, I sort of gave you the long way about how I don't think that the powers that be are going to let this thing crash. And you're not supposed to be able to do that. Dollar down, stocks up. What does that mean, though, from a Main Street perspective? I mean, so if you went heavy and you bought in 2013 at the Dow, you bought it at 16,000, now it's at 50,000. Is this even remotely healthy, what's happened here? Take a look at what growth was back in the day. This is actually back when you would argue that the United States was economically infinitely stronger than it is now. Nobody wants to hear that, but it's the truth. Inflation was very low. If you wanted a job in the 1950s and 60s, you got one. You went out and got one. I remember hearing the stories from the old timers, my parents. I mean, they worked. They had a job. You had enough money you had enough money to buy a house, to have cars, and for only one parent to be working. And now you've got pretty much everybody in the family working. You can't afford a house, and everything's extremely expensive. This stock market rally doesn't necessarily correlate with the quality of life, and that's what a lot of people in Washington D.C. are getting wrong, and that's why there's going to be major changes politically around the world in the next decade. And I mean, they're going to be very severe. They're going to be massive. So what happened right here? 2016, what happened right here? January 2020. COVID. Look at the gains since COVID. There's 2020. You can see the sell-off right there during COVID. Wiped everybody out, panics, 7% overnight. I remember it. Circuit breakers were getting hit. My eyes lit up. I said, wow, the opportunity. I put all my money in my stock trading account and started picking stocks. One of the best picks was Halliburton, was an absolute banger. You were getting stocks like Boeing cheap. You were getting Boeing was a great one. You were getting that. You were getting everything so cheap because you knew that they weren't the big dogs. As long as you picked a company that the government wasn't going to let fail. The airlines were great plays. They were incredibly risky, but they were great plays. And that sell-off right there was the only real pullback you had for a decade, right? Pullback, and now you're going up. So is this really an indication of a stronger, more robust U.S. economy, or is this an indication of just sort of a dollar that isn't what it once was? Now, we could pull a dollar index chart on the same time frame. Does this mean the dollar's, weaker? The dollar really hasn't done anything since 2002, dollar index. What this chart doesn't show you is all the other global currencies have inflated away their value as well. So what are we doing? What I'm trying to say is a lot of guys have been calling for a market crash. I was one of them last year. I said these markets are going to crash. And we got a bit of a sell-off right there. That was your tariff panic. And since then, it's just been everybody steps up and they buy dips over and over and over and over again. And at this point, what would a crash really mean? Boom. What would we sell off? Maybe to pre-COVID levels? That'd be a hell of a crash. That'd be a monster haircut right there. But this, I mean, remember that video we made, Rally-Based Rally? That old, the smart money concept thing where you get the big rally and then you get the base and the rally? I mean, if you were playing a crash type of a mentality, where do you think the entire world is going to buy? They're going to buy right on that base support zone. They're going to go rally-based rally, right? There's your rally, there's your base, there's your rally. Where's everybody going to buy their stocks? They're going to buy it right there, right there. Does it happen? I don't believe so. I really don't. So Shane, why don't you buy it, put all your money into stocks? Because it doesn't work that way. Let's say I need my money for some reason. That's the thing about buying and holding and just going for it, staying long no matter what, like a Warren Buffett would tell you, or Charlie Unger, or all the Munger, whatever his name is, and all these guys are going to tell you, buy and hold, buy and hold, buy and hold. And I go, that's great. And we can buy and hold. The problem is if retirement time was right here and you bought here, oh no. Let's say you bought here and you had retirement. Oh no. I had family that happened to. They were trying to retire and this COVID thing shook them up. They were trying to retire back there in 2008. This was horrible. 33%. That was an absolute huge haircut. Huge haircut. So this was sort of a real sell-off from a global liquidity crunch. This was COVID, an outlier. So to me, I don't think they're ever going to let the markets crash. They're going to inflate. They're going to try to inflate everything away. And as long as the notional, maybe not the notional value, but just the aggregate value of these markets keeps going up, up, up and away, that sort of offsets the lost purchasing power of your money. At least that's going to be the talk. The problem is that 60 or 70% of this country, the United States, doesn't own stocks. And if you don't own stocks, then who cares how high the Dow goes? That's why there's going to be a major transformation in the next decade. I'm relatively sure of it. So we'll see exactly how it goes. All right, everybody. I've gone on for about an hour, and a lot of that was just philosophy on why we're not going to get a big market crash. Now, don't get me wrong. You could get a periodic washout. I would love a 20% washout. We'll step up with both hands and just buy it. But, if we didn't get a washout on the onset of this Iran war, when's the washout going to come? I mean, really, when would it come? Crazy. It's crazy stuff out there. So you got a few questions here, and then I'm going to go ahead and sign off. Let me see. Team Marina, hey, Shane, for the currencies within the DXY, what determines the percent makeup of each currency? That's a great question. Basically, it's just a basket. So I would say that I don't even remember. I did a bunch of work on this at one point. I hate to tell you this, but probably just go on to AI and see if you can do it. See if you can find out what the percentage is and how they adjust it. I don't know off the top of my head, T. I really don't. I know that the euro had a big stake. Also, the Swiss franc had a big stake. Great Britain pound was big. And I believe those took precedent over the dollar CAD and the New Zealand dollar and also the yen. But I don't know that. I don't know that for sure. That's for sure. Let me see. Show me the charts. Let me see, Daniel. This will be the biggest transfer in wealth form from the have-nots to the haves. I'll tell you what, guys. I mean, you go on vacation and sort of get into that spending mode as opposed to making mode. So we're in the office here and we're doing things and we're making money. And then you go on holiday and you start spending money and you see just how fast it goes. I mean, just to do things that, just talking about maybe going out to dinner or lunch once a day and you see the price of things. It blows me away. Absolutely blows me away how much things cost. Is there any deals to be had out there right now? No. How much money would you really need to retire? The old number was, hey, you had $1 million, you can retire. And I don't think you can do it now. Not in this environment. I wouldn't worry about any of that. Never going to hear a financial person tell you that, but I wouldn't worry about any of that. Let's get in these markets. Let's establish some consistency. Let's see if we can make money every day. That's what I would recommend. And if you can do that, the rest will take care of itself. It really will. Don't be an idiot going and buying Lamborghinis and stuff and spending, $500 a night on dinner or something. But be a little bit frugal. Not frugal with your money, but be smart with it. Treat yourself when you have to. But make money every day. That's got to be it. All right, everybody, I'm going to go ahead and sign off. By the way, I can see your deep tan, too. Nice and golden. Thanks, T. I get pretty tan. That Florida sun will get you. All right, everybody, I'm going to go ahead and sign off. You have a fantastic trading session. We're going to be back tomorrow. We're going to give you the latest on Iran. We'll look at some poly market odds. We'll probably break down what Trump says. He's talking every day now, so we'll look at that as well. Also, I want to dive into this Kevin Warsh thing. We need to talk about that, and we'll also hit up another trade idea and take a look at our key levels. We didn't really cover a tremendous number of markets today, only about 10 of them. We'll also take a look at our 9 EMA. That was interesting. I was looking at that this morning. And also a 920. We'll have a few 920 trades for you as well. Those performed pretty well. That EURUSD 920 performed pretty well that we put out before I went away. All right, everybody. All right, Team Marina, let's see. Euro makes up 57 cents. The yen at 13, pound CAD. Man, the Swissie's only 3.6%. I bet you the I bet you the Swiss National Bank's pissed off about that. They'd probably say, hey, we need a bigger stake in that. I guarantee it. Absolutely, Daniel. You're welcome. Thanks for joining me, guys, over in the How to Trade community. My pleasure, Bobby Bob. Thank you, Coach. Happy to see you back. I'm happy to be back. Ralph H., always a pleasure. Ralph and Tuku, you're 100% welcome. Thanks for joining every single day. A lot of you guys do. And if you have any questions at all, reach out to me over at howtotrade.com. Just send me a private message, and I will get back to you in short order. If you need anything at all in the markets, reach out to the folks at Switch. They got a lot of promotions going on right now. I'll have more for that, more on that tomorrow. And check out our YouTube channel over there at Switch Markets. It's a small one, pretty lonely over there, but we're putting out new content all the time, so feel free to check that out. All right, everybody. That's a wrap for today. Geez, we ran long, but it was good. A lot of fun. Good to be back. All right, we're going to wrap up this week on a good note. I think it's going to be a really solid period of trade. Watching Trump closely, but we'll see. We'll see how it goes. All right, everybody, have a fantastic trading session. As always, trade the action well, and we'll talk soon. See you.